In today's special report, we'll be covering due diligence. The reason is that it is so much tougher in today's fast-paced M&A environment. Just listen to this story.
The buyer's responses today require a much heavier workload than our prior sale with Corum. They got us to the right buyers with the extra resources needed.
Due diligence is a key stage for financing and tech M&A transactions alike. Yet, it is often a misunderstood process. It is more than a document review game played by lawyers and accountants. It's an extremely involved and complicated process where every aspect of your company is placed under a microscope. And you, as CEO, are a key part of it. Currently, private equity firms, PEs, set the best practices as the leading buyers by deal volume. And PEs often hire outside services firms to handle due diligence because of how meticulous and time-consuming it is. What does this mean for U.S. sellers? Now more than ever, you need to know what's required in due diligence, and you need to meet a higher standard set of expectations. You're working with professionals on the other side. If you're not prepared, you won't survive due diligence, let alone the deal. So even if you aren't thinking of an M&A exit now, pay attention. As the saying goes, nothing good ever happens in due diligence. Here are 12 tips to help you avoid the due diligence landmines.
Number 1. Understand the buyer due diligence checklist. This is the document used to comprehend all aspects of your business before final purchase. It will list all the information that needs to be produced. The information should also be strategically prioritized. Keep in mind, some of that information is very sensitive and could be damaging to your company if the deal doesn't go through. Know what will be on it and how or when to share it. We can supply sample lists.
Number 2. Prepare your data room in advance. Get all your critical documentation securely stored in a place where you can give potential buyers appropriate, managed access. The questions from the due diligence team are deeper and more complex today. Being able to respond to buyers' inquiries professionally is critical and reflects on you and how well you know and run the business. Done right, it reinforces trust. You can't just wave off questions or requests. Professional companies like Deloitte, KPMG, and EY specialize in due diligence and will pursue your responses to the end. Again, you need to meet their expectations.
Number 3. Deal with accounting problems ahead of time. Remember, most buyers prefer accrual accounting rather than one that's cash basis, prefer to have revenue recognized over the period of time it is earned, and prefer performance statements without accounting treatment, so if need be, they can adjust the purchase price for capitalized costs.
Number 4. Control the timing of disclosures. If there are issues that will arise during due diligence, it's best to get issues out early in the process, when you've got the most leverage. Preferably working through issues in the discovery diligence phase, that is, pre-LOI, gives you the most leverage while negotiating the LOI. Exposing issues late hurts trust and kills deals. Also related, it's good practice to limit the buyer's access to only a few staff members deemed critical to the transactions.
Number 5. Run a parallel due diligence final agreement process. After signing the letter of intent, you should begin 2 parallel processes. The first is due diligence about all aspects of the business, financials, ownership, etc. The second is preparation of the definitive agreement, whether a merger, acquisition, or recapitalization. Information discovered about the company during due diligence will affect the contract, such as escrows, liability carve-outs, etc., and adjustments to price or deal structure.
Number 6. Get a draft agreement within 2 weeks. The buyer and their lawyers produce the purchase agreement. The first draft should be issued as quickly as possible. It's important to know what additional opinions, addendums, and schedules will be required by their attorneys. If these are asked for late in the process, it can create delays, extra expenses, and more stress. In addition to the purchase agreement, the attachments, disclosures, and schedules is an equally big lift to completing the deal. So good document preparation eases this critical aspect.
Number 7, appoint a due diligence coordinator. It is tempting for you as CEO to personally control production of the due diligence documents, but it's critical that you keep the company on track as to avoid missing key financial targets. So consider appointing a trusted, responsible coordinator.
Number 8, Inform key employees only. As we already mentioned, the due diligence process involves the sharing of the most sensitive information about the company. Even on your side, you should only inform employees involved in the due diligence process, like the CFO and CTO. The problem is without all the details ironed out, employees can quickly develop concerns, worrying about their future and what they'll get out of the deal.
Number 9, watch working capital. Buyers don't want your debt, but they do want the cash that's on your balance sheet and all your receivables. It helps them pay for the investment. So issues like quality of earnings, revenues, receivables, payables, collection rates, churn, retention rates, bad debt, bonuses, vacation accruals, etc. will need to be sorted out. Working capital is a moving target, so keep a close eye on it. A clear understanding of this early will avoid last-minute drama.
Number 10. Use your accountants effectively. Deploy your accountant before the due diligence process begins. If there are policy concerns or expected quality of revenue issues, be ready to answer. Your accountants need to be prepared so they can respond to buyer requests quickly and avoid creating delays.
Number 11, hire a tech M&A lawyer. Don't hire the guy you went to school with or your neighbor. You need a tech M&A specialist who has plenty of deal experience, especially with IP. The toughest, most stressful negotiations are about post-transaction liabilities specific to our industry. These come in the last mile of due diligence and contract preparation and can be very stressful if you don't have experienced professionals on your side.
Number 12. Choose the right intermediary. Who you choose to guide you through the most important transaction of your life is crucial, starting with proper preparation, positioning, buyer research, and document production, allowing you to focus on running your business. They know the buyers and what they want, how to value, structure, and negotiate with them to create an auction environment for an optimal outcome. Just as important, they know how to get you through due diligence and contract phase, where too many deals die, because they know the buyer tactics used during due diligence to lower the value. This is where experience really makes a difference.